Hey, today we're going to look at some macroeconomic data that is compiled by the Conference Board. The Conference Board is an entity out of Michigan which compiles economic data. It surveys corporate governmental leaders in terms of how they feel about what's going on in the economy, how their businesses are being run. And one of the things we're trying to get a handle on, many of you are aware that there's a lot of buzz in the press about a recession coming, and that's a big deal for those of us in the real property business. And as you're aware, the Fed came out yesterday, which was September 21st, and increased interest rates again, and stated their intent to keep increasing interest rates until they feel that inflation is under control. So increasing interest rates are a not good environment for the economy, and they're not good for real property because 85% of housing is purchased with somebody else's money, which is defined as a mortgage. So increasing mortgage rates typically produce lower levels of real property purchases, and they also have a tendency to put a ceiling on house prices, and in many instances, in many markets, they lower house prices. So this is a little bit of a wonky economic thing, so hang with me, and we're going to go over some graphs. They compile what they call the Conference Board Leading Economic Index, and the headline for this is that this is the 6th straight month that this index has turned negative. We'll look at this graph, and we're going to focus on the blue, and this goes all the way back to 2000. Pay attention to the shaded areas because these are recessions. This was the first recession. This one from March of 2001 to November of 2001. Here's the Great Recession. This went from December of 2007 to June of 2009. And here's the short COVID recession blip from February of 2020 to April of 2020. And you can see these downward trends in this blue line are predictive of what a recession. So a recession happens. So when this leading economic index goes down, a recession follows. So why are they so smart? Well, that's not really for me to say, but it is important to know, like, hey, you can put up a graph and it can say one thing. You can put up a graph to make it say what you want to say. But if you look at this index going back to 2000, when there is a sharp downward trend, it is predictive of a recession that follows. So pay attention to this red line here, and you'll notice that when this trend started going down here, there's a gap in the white line between that and when the recession actually happened. So they declared that when this index went below zero, so this is a positive territory and this is negative territory. So when this line goes in negative for a consistent period of time, is predictive of a recession. Well, it certainly happened in 2001, certainly happened in the Great Recession, and then it happened in the COVID recession as well. But if we look at here, August 22 is really where they're going to say that there is a high risk of recession, and it's specifically due to the decrease in this line downward. And once again, this is a percentage change year over year, and this graph kind of matches the other graphs up there. So they're pretty good in terms of predicting when a recession is going to occur. So you're going to say, okay, what's in this index? And this is a little bit wonky, but it is important because they do compile a lot of key economic indicators. It's not some sort of hidden index or their opinion about what's going to happen, but they do. There's a lot of things that they look at, and we'll just touch on some. So average weekly hours in manufacturing, average weekly initial claims for unemployment insurance. And then we have a couple things regarding the manufacturing. They will look at real property building permits for new private housing units. And as we've felt, the S&P 500 index, which is on a downward trend as of September of 2022, and then the interest rate spread, the 10-year Treasury bond less the federal funds rate, and then average consumer expectations for business conditions. All those things are negative. All those things are compiled into that. So the reason I bring this up is it's really important for our market. We tend to be in a bubble. We certainly think that RTP is immune from national and international economic influences, but it's not. Those of you that were in the Great Recession knew that there are people that had a lot of hardship with real property during that. But you can see that this is fairly predictive about a recession happening, and there are business conditions that you need to convey to your buyers and your sellers about what will happen in the market during recession. So once again, the main intent of this video is to keep you tuned in and up to date on macroeconomic conditions.